very difficult task because after such amazing videos, we're going to be talking about finance. So we will try to keep you everybody alive. I hope you all got a good dose of coffee. And as was described, before joining in the Middle East, I was in Europe and I joined several hotel transactions in Europe, and therefore I experienced several financing conditions. So when I looked at the UAE, we really have all the wish list that any investors would ever dream of. The market is going extremely well. The profitability is extremely high. We saw with the presentation yesterday, not stats. There is a big political push across all the GCC countries. There is no exchange risk if you are investing in US dollars. Union, we saw with the New York hotel yesterday how the profitability, especially in the F&B, is compromised. In Europe, ESG is a big topic. Here has not yet arrived. So Lily, whatever you want, the UAE have it. Why don't we have massive foreign direct investment coming into the UAE? So maybe let's look at the financing conditions and let's see how that changes. So the first question would be for you, Andreas. I would like you to jump on a flight, go back to Europe or London. Imagine you're sitting in the city. How do you see financing conditions in very mature markets at the moment?
Sure. Can you hear me okay? Everyone hear me?
All right.
Listen, thanks for having me. First of all, pleasure's all mine. I would say we're very fortunate at FAB to have had a long-standing presence in many mature global markets, which has allowed us to develop a really well-established loan portfolio over the last decade or so, not least in hospitality, where we've been considerably active over the last 3 years, I think, as much as any lender could be through the pandemic, through the cycle. We supported our clients' investment journeys and that extends from West Coast US to another 10 states across the US to many European markets and gateway cities and into certain Asian markets. What we see from a financing structure, however, is pretty uniform, right? These tend to be SPV, non-recourse asset financings. They tend to be shorter term, up to 5 years, sensibly levered, in the range of 50 to 60% LTVs, and soft and hard covenant profiles with a focus on cash flows. And most important part is interest-only structures. There tends not to be a rush to an amortizing profile, and some of the same concerns that you would have in our domestic market are much less prevalent in those markets.
So from that perspective, if I were now to ask you to jump on another flight and come back, what do you think, how that would differentiate with local financing? And how would you differentiate between local financing, local entities investing abroad and local entities investing in the region?
Sure. So I think structures are more varied here. I think there are SPV asset-specific financings, but what I tend to see being more prevalent is corporate owners, either of hospitality or of broader real estate, or in fact even conglomerates with completely diversified revenue streams, borrowing at their level, right? So the focus becomes less on asset strength and away from necessarily a focus on KPIs and to more of a corporate strength, right? Now that can take many forms of analysis. By doing that, de facto, you tend to end up with a more relationship-driven model, B, longer-term instruments. What comes with longer-term instruments, if you're providing 7 to 10-year financing compared to 3 or 5 years in the markets that I mentioned, lenders are, of course, going to be more focused on the residuals at that point, right? What does this look like in 7, 10 years? Maybe have to sensitize the reserves much more than you would in a shorter-term loan. Here, I really need to focus on the end use, right? What does this look like? What new areas and competing product have been established in that time frame, right? Which could be extensive. Again, that's not necessarily the case if you're lending into Knightsbridge or Fifth Avenue. So there are different dynamics at play there.
First of all, absolutely. But if you were to describe what a general financing would look like for, maybe this question is more for you, Dale, if you were to describe what a financing product would look like for this market, for investors that are from this region, which kind of characteristic would you have? Which kind of term, loan to value, interest rate?
And so in this market or the GCC region, typically we still see pretty much the plain vanilla type of structure, which is typically longer tenor compared to the European or US or the more mature markets, and amortized structure with or without a balloon. And in terms of the security, we would of course have the mortgage, the asset as a mortgage, as a security. In addition, bank would often require corporate collateral or the personal guarantees that to warrant the repayment.
I mean, let's focus a little bit on the security. If the investors is coming from this region, of course, the relationship with the bank is already existing. Maybe there is already a credit line that is already activated. But if the investors would be a first-time investors coming to the Middle East, and therefore also a first-time client for the bank, which kind of additional comfort would the bank request?
So first of all is the KYC and of course the clearance of the names. Everything will for sure warrant the possibility or whether the lending and asset is possible to look at. In addition, possibly looking at the strength of the buyer, whether or the borrower, whether there's any historical or like track record of operating or own or investing such assets of elsewhere and successfully, having the facility issued or refinanced or financed through other channels or other where in the world. And in addition to that, if the asset is very strong, with a very strong performance, with the good cash flows, potentially with the lower LTVs or the facility, would not necessarily warrant certain additional, but with the first-time buyer, generally bank would look at the credibility of the investor. In addition, we may be some of the cash or cash equivalent deposits, and all of these securities can also be provided. But in general, for a first-time buyer, if the asset is strong, that will give some comfort of the bank. But usually, I would say a warranty or a collateral is required.
Okay, so maybe also a sort of some letter reference from the existing previous banks. But then, does it mean that local investors and first-time international investors, they don't play with the same financing rules? Meaning, and maybe Andreas, this is a little bit for you, does it mean that the cost of the capital is going to be different? Is that going to be a detriment, or is that going to be in favor of local entity when they want to bid for the same assets?
Sure, let me try this microphone now. Look, the first thing to say, sponsorship is key for every lender, right? It's our first focus at FAB and kind of underpins everything that we do. Now, we talked about this earlier, top-tier sponsorship coming into this market, and like major definition of top-tier sponsorship, I would call, Blackstone, GIC, whoever it may be, of that nature, entering this market or any new market. Typically, you would see them almost dragging best practice lending from mature markets and imposing those terms on the market. Certainly over time that will happen, if not instantly. So that's probably the first thing to say. If it's that type of sponsorship group, I don't see a material difference in what terms would be for them compared to a major local name. Now, in the mid-market space, somebody coming new entrant to the market, new to bank, that's probably a different dynamic. You are into, if you can get the deal done, right? I think for lenders, you're going to need additional recourse. Now, that might take the form of guarantee or equity commitment letter for interest until a certain performance threshold is met. It may be for capital expenditure programs. It may even be for a notional element of the principal. And you typically see that those maybe either being a feature in permanently for the first transaction, or certainly falling away upon achievement of certain performance thresholds. Now that is purely what the EBITDA or NOI is doing as a function of the debt amount, right? It's probably it'd be nothing more curated than that. But that's how we would think about it. As for the cost, yeah, in the secondary circumstance, you may in fact offset the decreased risk through
additional recourse, which actually bridges the delta that you may otherwise have had. So I actually don't necessarily see there being a fundamental difference in cost of capital.
So maybe we're talking about, we need to differentiate between, as you said, the top tier sponsorship and the second tier sponsorship, because the financing conditions would be quite different, especially on the comfort aspect that the bank may require. But at the same time, and again, just to try to push a little bit, there is also a missing opportunity if the bank is not able to meet the requirements that top tier sponsorship wants to get. Then it means they're probably going to look elsewhere for financing. So in a way, there is a little bit of we want to keep this deal in-house and we want to start having a relationship with this top-tier sponsorship. So there is a little bit of a balance in the negotiation between the investors and the local financing. Going still on that point, we discussed the cash on cash. If we extend the term, how much would the bank interested in monitoring or controlling the financial results of the asset, and which kind of caveats would they put in place to make sure that that happens?
I'm happy to go take that. Look, I'll speak from our experience and how we approach financings. And we have come from a position where, obviously, over the last 2-3 years, there has been a transition either back to stabilization or to stabilization, depending on the nature of the underlyings at the point in time of which we finance them. In every circumstance, we have the same focus on controls, right? You have real focus on KPIs, real analysis and depth in your underwriting of the sensitivities of the trading projections. I won't speak for us, that wouldn't change 12 months on compared to 70 or 80 months on, right? That's not how we would think about things. What you do think about, right, is I need to use some of that excess cash that you ought to have, right? Otherwise you may not be doing the deal in the first place. I need to access some of that to pay down my loan as you extend out the term, right? That's just the nature of the residual value and where you're prepared to take risk. And again, you might not necessarily do that in London or Paris, but you tend not to get requests for longer term financing than the terms that I mentioned earlier. So.
Okay, and changing a little bit the topic, this is more of a traditional financing, but in more mature destinations, you also have access to alternative way of financing. Yep. And I'm referring to alternative entities or mezzanine financing. So this is not happening as much as in other destinations, especially in this part of the world. Is there any specific reason? Is there any licensing issue for that? How come that this is not yet as developed as? It's for both.
You go first.
Okay, I'll go first. So I think traditionally we've not seen this kind of mezz finance or equity investment into the space, because one of the reasons could be a liquidity issue, because there was historically lack of hospitality assets for investment and not many quality assets in the market. Now with the last 10 years or the most recent 5 years, there's a significant amount of hotels and quality assets in the market, and everyone's here looking at many of the investment opportunity for hospitality. This will improve. So with the lack of liquidity, this could be one of the potential reasons why the equity investments are not often seen. But that being said, there are actually certain cases that high-profile projects we've seen mezz finances in the market.
And is mezz financed locally?
Locally.
Okay. Well, that's very interesting. Andreas, do you have anything to add on that?
Sure. Look, I think, as Dale mentions, right, there are, not necessarily within real estate, but it's probably pretty new and pretty infrequent, but there are major global names that are now starting to look at the provision of mezzanine financing in the leverage and acquisition space. There's certainly local entities doing that. I think historically there has been less of a requirement here compared to other markets, simply because of the relationship lending nature of the financing markets, which has taken notional leverage points to a level that you may not typically see in other markets. So I think that's the first thing. I think you're right. I think there needs to be and ought to be a requirement for this market to operate. Look, you want to be an international market, you have to behave like an international market. That requires capital through the stack. It requires capital through the cycle. It requires different forms of capital, right? Transitional all the way through to permanent. There probably has been a little bit of uncertainty around kind of major, let's say US private equity coming here, they would definitely require a meaningful risk premium in their eyes for the enhanced risk of lending here, right? There is not yet a depth of body of work to provide the transparency that you may get in other markets that make you readily identify a return level that precipitates your involvement in a certain market. So that will happen again, I'm pretty sure, as has been mentioned here, right? The NOI and purely in hospitality, for example, right, relative to almost every other market, would purely necessitate greater lending volumes through the capital stack. But when you are faced with uncertainty around, what does it look like in a downside scenario? How do sponsors behave? What is the regulatory and jurisdictional and jurisprudence regimes? It remains untested. So it's until somebody jumps first, I think you need to see a few examples of that. I don't see somebody jumping first from the US or Germany necessarily. I see it being more local led, and then a body of work will be created that you can say, yeah, fine, I can now underpin my analysis in it before entering this market in that space.
Okay, we just have very little time. I just want to have very provocative questions. If you are a top-tier sponsors, Host Hotels and Resorts at Blackstone, you want to invest in 2 billion dirhams in the UAE. We discussed about the residual land value at the end of the term. Where would you park your money very quickly? How much would you loan to value that?
I think it depends on the project location, the operator, the cash flow strength, and the business plan. So top tier often will get more favorable or more preferred terms, but the fundamental, the asset is the business plan, the asset has to be strong.
Okay, Andreas?
4 seconds left. Look, locationally, you're now getting to the point where I mentioned, right? Dubai and Abu Dhabi, you are getting clear to the point where you can identify the Knightsbridge equivalent, right? The Central Park equivalent. But I wouldn't like to necessarily say it would depend on the nature of the operation. But I think luxury beachside resorts in Dubai have performed tremendously well, right? I think, and will continue to do so, right? This is now one of the most established tourism markets globally, and we should all be pretty grateful for that.
All right. Well, it seems we have done another job on financing. Now it's on the next panel. So Yazan, Amr, PJ, we worked on that. Now it's for you to do transactions. Thank you very much.
Fantastic.
Thank you.